All right, today we're breaking down a really massive and pretty unusual financial bet that just lit up the markets. And get this, it's not a story about someone betting a stock is going to go to the moon. Nope. This is about a very sophisticated player betting millions that a company simply won't crash. Okay, let's get into it.
It all started with this number, 5,555. On January 13, 2026, this huge, single block of option contracts just appeared on the market, and they were all aimed at one company, the logistics giant XPO. Now, a number that specific, that's not random. That's a signal that something big is going down.
And we are not talking about pocket change here. Those contracts represented a potential obligation of almost $64 million. This is what Wall Street calls a whale trade, a move so large it makes a huge splash, and it gets everyone else in the market to turn their heads and ask one simple question.
Yeah, why? Why would an investor, someone with access to incredible data and research, put so much on the line with such a specific bet? That is the mystery we're going to unravel in this explainer. What did they see that maybe everyone else was missing?
So to really understand the why, we first need to zoom out and look at the bigger picture. See, this trade didn't just happen in a vacuum. It happened in a very specific economic environment that's kind of forcing big money to get creative.
To really get this, you have to put yourself in the world of January 2026, where safe investing offered, pretty slim pickings. If you bought a 10-year U.S. government bond, one of the safest assets on the planet, you'd only get back about 4.18%. For huge funds that need to generate income, that's just not going to cut it. So they're all on the hunt for better returns, or what they call yield.
And this is where it gets really interesting. Look at this comparison. Over on the left, you've got that safe but kind of boring return from the Treasury bond. But on the right, the potential annualized return from this one XPO trade is almost 7.1%. That is a massive difference, and it explains exactly why investors are willing to take on these smart, calculated risks to find these kinds of opportunities.
So, how in the world did this investor structure a trade to get that kind of return? Well, it all comes down to the financial tool at the very heart of this $64 million mystery.
The tool is called a put option. But here's the key. The investor wasn't buying these, they were selling them. Now, selling a put option is a lot like being an insurance company. You get to collect a cash payment right up front. It's called a premium. And in exchange, you're just agreeing to buy a stock at a certain price if it crashes.
Here's how it works. It's pretty simple. First, you pick a stock and a price. That's the strike price that you're really confident it won't drop below. Then you sell that put option and you immediately collect that cash premium. And as long as the stock stays above your price by the expiration date, you just keep the premium. It's pure profit.
So here's the bottom line. This entire massive trade can be boiled down to one really powerful statement. The whale is pretty much declaring to the entire market, we are so confident XPO won't collapse, we are willing to be on the hook to buy nearly $64 million worth of it at $115 a share. That is drawing a very clear line in the sand.
That kind of conviction just forces you to ask, what is it about XPO? Why this company? So let's take a closer look at the business at the very center of this huge bet.
So XPO has actually transformed itself quite a bit recently. After spinning off other parts of its business, it's now laser-focused on just one thing, less than truckload shipping. That's just the business of moving freight for a bunch of different customers on a single truck. And their LTL 2.0 strategy is all about efficiency and quality, which has given them some real pricing power in the industry.
Now, not everyone is convinced. As you can see on the left, you've got some analysts who are a little concerned. They're pointing to a high valuation, and they've recently issued downgrades. But our whale's perspective, over on the right, is different. They likely believe all this bad news is already baked into the price, and, here's the kicker, even the most pessimistic analysts have price targets way, way above that $115 line in the sand.
And this right here, this brings us to the real genius of how this trade was built. It's not just based on a gut feeling. It's a calculated position with multiple layers of safety built right in.
Check this number out. This is the key. For this trade to even begin to lose money, the stock, which was trading around $146, would need to absolutely crash by almost 22% in just 38 days. A drop that big for a company this size without some catastrophe is statistically very, very unlikely. And this just brilliantly illustrates the multiple walls of defense. That $115 strike price, it wasn't chosen at random. It sits below several key technical support levels the traders watch like a hawk. You can think of it like a fortress. The stock price would have to break through a moderate wall, then a strong wall, and then a very strong wall before it even gets to the final line of defense at $115.
The timing is also just critical. The trade was deliberately set to expire after the company's earnings report. In the days leading up to earnings, uncertainty and fear are super high, which makes that premium, that insurance payment, way more expensive. So the strategy is to sell that expensive fear, wait for the news to come out, and then profit as all that uncertainty just instantly vanishes.
Of course, no trade is without risk, especially not one of this size. So, to be fair, we have to look at what could possibly make this fortress crumble.
While the first risk is the market itself, XPO is what's called a high beta stock. As this chart shows, that just means the stock tends to be more volatile than the overall market. So, if the S&P 500 has a bad month and drops 10%, XPO is likely to fall even further, maybe by over 16%.
Beyond a general market downturn, what if bad news from a major competitor spooks investors and hits the whole trucking sector? And if the stock does start to fall fast and gets close to that 115 strike price, the potential losses can start to accelerate really quickly. It's a dynamic in options where small drops can cause big losses the closer you get. So this is not a set it and forget it kind of trade.
So what's the final verdict here? After breaking it all down, it becomes really clear this isn't some speculative gamble on growth. It's a highly calculated, almost defensive bet. The investor isn't betting XPO will soar. They're making a high probability bet that a solid company, protected by all these layers of support, simply won't fall off a cliff.
And that really leaves us with a fascinating question to think about. In a world that is so hungry for yield, maybe the future of smart investing isn't just about finding the next stock that's going to skyrocket, but maybe it's more about identifying stable assets and just getting paid to sell insurance against disasters that are pretty unlikely to happen.